Hello, I'm Ryan Lightfoot-Amanoff of Chelsea Financial Services, and today I'm joined by Rosemary Banyard, manager of the VT Downing Unique Opportunities Fund, which is on Chelsea's selection. Rosemary, thank you very much for your time.
Pleasure.
Now, your fund is about 16 months old, having been launched in March 2020. Quite a difficult time to launch a fund when global stock markets were tumbling. Since that, you've returned more than 75% to investors, 10 percentage points more than the average UK equity fund. You must be really pleased with your success. Where has it come from?
Thank you. And yes, I am pleased. One thing that's quite interesting, so I've been looking at the data from the launch in March 2020 to the end of June, because we're about to produce our first set of accounts. And in that period, the average cash balances for the fund were 20%. So actually, I think that the fund stocks, the stock selection has been, really, really encouraging. Because obviously the overall return has been diluted by cash early on, after launch. And there are a couple of things to say that have done particularly well. The first is that the best performing investment of all was Impact's asset management. And this is obviously a business which is gaining a huge amount of assets under management, both from institutions and private investors, as a leading proponent of sustainable investing. And they've been doing that for 20 years. So they've got huge track record and credibility. If we look down the list beyond that, the next three best performers are all in the technology space. So that's speaking to, digital everything, Kainos, for example, which is helping the UK government to digitalise its services to citizens, is one of them.
And actually, while we're on those technology names, while we were looking at your numbers, we noticed that both the average fund, and therefore you by even more, has outperformed the S&P since you've launched the US stock market, which has got the likes of Amazon and Microsoft. That's really quite surprising. A lot of the focus has been on how those big tech giants have done. What's the story behind the UK stock market performance? And do you think there's more to come?
Yeah, that's interesting, isn't it? So, I mean, for me, technology is my biggest single sectoral position, and it's something like 20% of the fund. But obviously, I'm not a technology fund as such. And the technology names actually that I own have all done well, pretty much without exception. But I think the story for the UK more generally is firstly that we are very far advanced in our vaccination program against COVID. And therefore, the economy has been able to open up more fully and more quickly than many others. And secondly, I think we're seeing an awful lot of corporate activity, particularly bids, and some of them are trade bids, but a lot from private equity, which is, I think, demonstrating that the UK, having been perhaps a lagging market for a while, is offering a lot of attractive opportunities for these companies. It happens that I have only had one company in my fund that's had a couple of bid approaches, which is Elementis, a chemicals company, and I haven't had any other takeover approaches. But the market generally, has been very much buoyed up by those.
And have you seen any difference in sort of the size of companies that have driven the market? Have you seen small caps doing particularly well with large caps? I know you're a multi-cap fund, so you can take advantage of the differences there.
I wouldn't say so. My fund is focused on small and mid caps. So I've got one or two FTSE 100 companies, but I'm focused mainly a bit further down the size scale. That's my area of expertise historically. I think it's been quite widespread, but definitely technology. The UK doesn't have lots of big technology names, but a lot of the smaller ones have been trading really well.
And maybe sort of moving on to the IPO market, which has been another big driver. You said in your last update that it's been quite a notable period for IPOs in 2021, but you haven't participated in any. Why is this?
Well, I feel that IPOs, are quite risky. Everybody has all the same information at the point that the company comes to the market. Obviously, it's beholden on us to research that information and make sure we understand it well. But there's everybody has, as it were, the same insight, no more, no less. And I think there are definitely some companies that take a while to settle down to the market. And then when private equity are selling onto the market, they're usually quite clever about their timing. And one of the things I've observed with several of the companies that have come to the market in the last year is that they have been beneficiaries of COVID, in that they've been trading really well through lockdown. They've perhaps benefited from people purchasing more things online, for example, and then they've come to the market. And I think the pressure's now on for them to perhaps demonstrate that they're going to continue to trade as well when physical retail, for example, is opening up and people have more things to do out there than sit at their computer. So I'm just very wary of initial public offerings generally, and as you say, I haven't taken any.
Okay, and you touched on retail actually just there, so perhaps we can focus on one of your individual stocks. You've got Dunelm in your top 10. What is it about that company that you like particularly, and have you had a chance to go to an outlet since restrictions are lifted to sort of have a look at what they're doing?
Well, I haven't been to an outlet, although I did actually buy a pillow online during lockdown from them. So I am doing my little bit to support them. So Dunelm, well, it's interesting. So it's a market leader in the homewares market in the UK. And if you look in their latest accounts, they are claiming 7.6% share of that market. They're also in the furniture market, but they're much smaller, with a 1% share of a much more fragmented market. So they've got, a lot of leadership, and that gives them benefits. It gives them purchasing power. It gives them a lot of unique suppliers that they use, and also, Dunelm have a lot of freehold stores, which they've owned for many years, that were bought by the Adderley family, actually probably long before it came to the market. So their cost base in that regard is low. And under a newish management team, they are catching up quite a lot on selling online. They were, rather behind the curve, I would say. And so that's going well. And I think they've got a lot of opportunity in a lot of areas. So, for example, they don't, at the present time, sell anything online other than for cash. So they offer no credit, unlike, Next, for example. They have in stores just introduced things like paint and wallpaper. They are, I think, revamping their kitchen ranges. They just have a huge amount of opportunity wherever you look. So I think it's very well set as a business.
Oh, interesting. Thank you. And perhaps finally, can you tell us a bit about Auto Trader? Secondhand car sales have been one of the stories of the year, going through the roof recently. Has this helped the company, and do you see really good prospects for it?
Well, I see good prospects for it. And certainly one of the reasons the secondhand car market's been very strong is because people will be aware there have been silicon chip shortages, and so new car manufacturers have been struggling to actually get cars off the production line. So if you want a car, you're probably being driven, forgive the pun, towards the used market. in addition, I think people have, because of COVID, felt maybe uncomfortable about public transport. So more people have been wanting their own car. So a couple of things there. Insofar as Auto Trader is concerned, it's somewhat business as usual. So they put through a regular price increase on the 1st of April this year, and they are constantly improving their offer to their customers. The paying customers are the dealerships, not consumers. This contrasts very much with a year earlier, on the 1st of April 2020, when they actually raised 186 million in a placing because they were worried that they might have some difficulties with lockdown. In fact, I thought at the time they didn't really need the money, and so it's proved. And so they're now buying back their shares with that money because they don't need it. But in terms of the business, they benefit a bit when there's more volume on the site because their customers pay a bit more for more advertisements. But I think that the biggest story is around the opportunity for them to take much more of a share of the whole process of buying a car. So what do I mean? There are a couple of things coming down the tracks. They're in beta test on part exchange, guaranteed part exchange offer. If you want to look on their site and find a car, you can get a guaranteed price for your trade-in if you want. The second thing, which is probably a year away, is that they will be putting in the ability to put on your application form, application for a finance, and then to sort of link that into finance offers and find you the best finance offer. So they're beginning to offer the consumer much more of an added value proposition to buy a car. I think that it's still way and away the biggest site for search in the industry and looks very well set.
Well, Rosemary, that's been really interesting. Thank you very much for your time today.
Pleasure.
And if you'd like to know more about the BT Downing Unique Opportunities Fund, please visit our website, chelseafs.co.uk, and stay up to date with all of our videos. Please like and subscribe below.